Welcome back to the Deep Dive. Today, we're really getting into the weeds on the foundational layer of, well, the entire digital economy.
We are. We're looking at a huge question. Which architecture is actually going to win?
Exactly. Is it Chainlink or is it Quant? Which one is truly building that bridge between the old world of finance, they're talking multi-trillion-dollar markets, and the decentralized future?
And we have a pretty dense stack of sources today. A lot of recent analysis, some technical reports, and a lot of institutional partnership updates. It all really focuses on this core battle.
It's the classic infrastructure debate.
It is a decentralized Oracle network versus a DLT operating system.
Right. So for you, our mission today is, let's say, threefold. First, we need to nail down the real technical difference here. What is an Oracle versus a DLT operating system? Second, we have to look at the specific projects Quant is in. I mean, the real high-stakes stuff. Central banks, government initiatives.
The things that validate their entire enterprise focus.
Yes. And finally, we have to understand why Quant's token supply, which is just astonishingly scarce, why that actually matters, especially when you think about how slow central banks are to adopt anything.
And to really get the stakes here, you have to look at the scale. The infrastructure we're talking about today, it's already supporting a DeFi space with a total value locked, TVL of over $150 billion.
It's incredible.
And that's just today. The projection everyone is watching is for tokenized real-world assets. So that's everything from bonds to real estate, but on-chain. That's projected to hit $16 trillion by 2030.
16 trillion. So these two projects are basically fighting to be the pipes that carry all of that value.
That's the game.
Okay, let's unpack this. Because they both say they solve interoperability, but how are they solving different problems? Let's start with the one everyone knows, Chainlink, L-I-N-K.
Right. So Chainlink is all about data integrity. It's its core function, and it's really the gold standard in Web3, is delivering secure, tamper-proof off-chain data.
So things like price feeds or weather data, stuff like that.
Exactly. Any kind of external data, and it delivers it directly to smart contracts that are already on-chain. It's the data highway for automation.
And their dominance in that space is, it's basically undeniable.
Oh, absolutely. The analysis we have shows Chainlink is securing over $20 trillion in cumulative transactional value.
20 trillion.
Its main use case is just DeFi dominance. Protocols like Aave and Compound, they simply couldn't function without Chainlink's price feeds, and now they're moving into cross-chain with their CCIP protocol.
Right, the cross-chain interoperability protocol. That's for moving tokens and data between blockchains.
Yes, and that's already being piloted by huge institutions. We're talking JP Morgan, MasterCard, they're all testing it.
Okay, so that sounds like a massive moat.
Yeah.
If LNK is handling data integrity and building the pipes between chains, what is Quant? With its Overledger OS, what are they even doing different?
They're tackling a completely different problem set, institutional integration. Think of Overledger OS as middleware, like an API gateway that sits between the old world and the new. It's designed to connect different blockchains, yes, but also legacy enterprise systems, government databases, and, this is critical, non-blockchain DLTs.
Wait, hold on. Non-blockchain DLTs, what does that mean?
So we saw in the sources they can connect to things like directed acyclic graphs, or DAGs. The main point is they're network agnostic.
I see.
Quant isn't just about connecting, say, Ethereum to Solana. It's designed to be this total abstraction layer, so an institution can build one application, an MD app, that works across totally different kinds of ledgers without touching the underlying code.
So to put it simply, LNK makes sure the data going into DeFi is secure, and QNT makes sure the systems, the huge, clunky databases that banks and governments can actually talk to these new ledger technologies.
That's a perfect synthesis. But here's where it gets interesting and, a little competitive. While their core functions are different, both Link's CCIP and QNT's Overledger are going after that institutional cross-chain connectivity market. CCIP is great for data and tokens, but Overledger is built from the ground up for the compliance and governance needs of central banks.
And this is where it gets really interesting, because Quant's strategy, it's not just a theory on a white paper, it's validated. They are involved in some of the most critical public sector projects in the world. Let's talk about Project Rosalind.
Project Waslin is probably the biggest piece of evidence we have for Quant's institutional moat. They collaborated directly with the Bank for International Settlements, the BIS, and the Bank of England on this.
And that wrapped up in mid-2023, right?
It did. And Quant's role was providing the core ledger and infrastructure expertise. Specifically, they used their Overledger API to explore how a retail CBDC.
It's like a digital pound or Bitcoin.
Exactly. How that system could actually interface with commercial banks and payment companies. This was real infrastructure building.
Which puts them right at the center of how this new monetary system is being designed.
It does. Because Project Roslyn basically validated what's called the two-tier model for CBDCs.
Okay, what's up?
The central bank, Tier 1, manages the core ledger, and the private sector, Tier 2, builds all the apps that customers actually use. Quant is that trusted bridge connecting those two tiers.
Okay, so let me see if I've got this right. The central bank has the master ledger, and Quant's Overledger API is like the authorized bouncer at the door. It lets commercial banks like HSBC or Barclays interact with the CBDC, but only in a way that follows the central bank's rules.
Precisely. The central bank keeps control, that's Tier 1, but they outsource all the innovation and customer service to the private sector, Tier 2. It's a huge distinction.
And this isn't just a UK thing. Their footprint is global. The European Central Bank, the ECB, has been a major headline for them.
Yes. The sources confirm they're involved in the digital euro project. They're actively testing how the Overledger API can handle things like cross-border CBDC settlements and programmable payments.
And the market reacts to that kind of news.
Oh, massively. We saw reports that news of their ECB involvement has historically caused these huge market reactions. I think there was a 101% price surge in May of 2025 alone.
Hold on, 101% just on news. I mean, given how glacially slow central banks move, how much of that is real validation versus just pure speculative hype?
And that is the critical friction you have to address. Central bank pilots can take years, even decades, to become real live systems. So while the partnership validates the tech is secure and compliant,
the price reaction is just speculation on the future.
It is. It's speculation on the potential revenue stream, especially when you factor in the token's scarcity, which we have to get to.
And it's not just central banks. They're also deep into traditional finance with Tier 1 commercial banks.
Absolutely. Through the Regulated Liability Network, the RLN in the UK, this is a huge initiative. You've got R3, HSBC, Citi, Standard Chartered, all the big players.
And what's the goal there?
The RLN is aiming to create a single shared ledger for handling both tokenized assets and just regular old traditional bank deposits. Quant is providing that interoperability layer to make it all work together.
And they're also plugging into the core enterprise software that these banks already use.
Exactly. Quant's Overledger Gateway is certified for the Oracle blockchain platform. And since Oracle is, it's foundational for global finance, this puts Quant right inside the existing ecosystem that these banks already live and breathe in.
Okay, let's connect all this utility, all this regulatory buy-in directly to the token, because this is where the two projects just diverge completely. We're talking scarcity versus abundance.
That's right. When you look at the supply, Chainlink is on an abundance model. 1 billion LINK total supply. The utility there is, Oracle rewards and security staking.
And then you have Quant.
Quant is on an extreme rarity model. The maximum supply of QNT is just 14.6 million tokens ever.
Wait, 14.6 million. That number is tiny. It's way less than Bitcoin's 21 million. How can a company that wants to be the operating system for global finance convince anyone that 14.6 million tokens is enough for the entire world?
That's the genius of their tokenomics design. It's built specifically for enterprise. QNT is a pure utility token. You need it to access Overledger, to pay gateway fees, to build these MD apps.
Okay, so you need it for access, but how does that solve the scarcity problem?
It's the licensing mechanism. This is the core of their whole valuation thesis.
Okay, explain it step by step.
So in enterprise, let's say a big bank joining the RLN, they pay their annual license fee in fiat, dollars, euros, whatever.
Right.
The Quant Treasury takes that fiat, but they don't just hold it. They use an internal oracle to immediately go to the open market and buy the equivalent amount of QNT tokens.
So every fiat payment is immediate buy pressure on the market.
Yes, and here's the crucial part. Those QNT tokens are not sold to the enterprise. They are locked. They are structurally removed from the circulating supply for the entire 12-month license period.
Wow, so it acts like a utilization-driven sink. It just pulls tokens out of the market.
Think of it like a financial escrow where they throw away the key for a year. Every single time a major bank or government renews their license, they are creating mandatory, recurring buy pressure and shrinking the available supply.
Which, if adoption scales, is designed to just amplify the value over time.
Exactly. It rewards long-term holders through network growth without ever needing token inflation.
That makes the low supply makes so much more sense. It's not about using one QNT for one transaction. It's about locking QNT to get a license to use the service.
You've got it. The supply is small because the token's job is access and licensing, not being the gas for transactions. And this is why those long, slow central bank sales cycles, while they're frustrating for traders.
They become critical accumulation periods for the locked supply.
Precisely.
Okay, so we've got the foundation, the partners, the unique tokenomics. Let's bring this into the near term. What does the 2026 roadmap look like?
The 2026 roadmap is all about bridging that gap from pilot project to full production. The biggest thing is the Quant Fusion Layer 2.5 solution, moving from DevNet to mainnet in Q1 2026.
Fusion Layer 2.5. What does that actually mean for a bank?
This is a huge deal for institutional compliance. It's designed to unify assets across both private, permissioned blockchains and public ones without using traditional bridges.
And traditional bridges are a massive security risk.
A notorious one. Regulated entities can't touch that risk. Fusion gives them a secure single ledger view across multiple chains.
And we're also seeing them move more towards decentralization.
Yes. Also in Q1 2026, they're launching the Trusted Node program. This will bring in QNT staking to incentivize holders and, decentralize the network.
Yeah.
That's essential for building trust with banks who can't rely on a centrally controlled system.
So all these tech upgrades are directly supporting the big banking projects they're in.
100%. The launch of QuantNet, which they call their programmable settlement network, is what's underpinning projects like the UK tokenized sterling deposits with Lloyds and Barclays. And we're seeing other code base work too, like open source connectors for Hedera and SUI, and testing multi-ledger rollups for scalability.
They're building for a massive volume.
They are.
Okay, that's the future. Let's talk about right now. What are the cold, hard market realities in late 2025?
So right now, QNT is highly volatile, trading in the low to mid $70 range. And the sources show that, like pretty much every other mid-cap altcoin, it's still highly correlated to the broader market. It just follows Bitcoin and Ethereum.
So it's caught in the speculative market dynamics, even with its strong enterprise fundamentals.
Exactly. It's suffering from this Bitcoin season trend where all the capital just rotates into BTC, which has, almost 60% market dominance right there.
And that puts pressure on alts like QNT.
It puts significant downward pressure. And you add to that derivatives activities down something like 12.5% in late December. That thins out liquidity and just makes the volatility even worse.
So from a technical standpoint, is there a floor here?
The indicators are giving really mixed signals. Some of the quant models are bearish, even screaming strong sell, but other sources point out that QNT is getting very close to oversold conditions. The RSI 7 is down around 31.
And what's the key level everyone's watching?
The $70 support level. If it holds that, the long-term thesis is fine, but if it breaks, it could easily retest its 2025 lows.
And yet, despite all that short-term noise, the long-term predictions we saw are, they're staggering.
They really are. There's low certainty on the timing, but extremely high confidence in the fundamental utility. Price targets for 2025 alone go from like $134 up to $440.
Wow.
And if you look out to 2030, some predictions suggest QNT could surpass $1,000. It just shows you the huge gap between the short-term market noise and the long-term potential.
So to bring this all together for you, we've established Quant is focused squarely on that institutional regulatory interoperability layer. It's middleware, and that's very different from Chainlink's dominance in DeFi data.
And critically, its long-term value is completely tied to those high-stakes partnerships. The Bank of England, the ECB, the Tier 1 banks, and the RLN. Those long sales cycles, they cause short-term pain, but they are the source of its future locked value.
And that structural scarcity is the real game changer. That 14.6 million max supply, plus the annual license locking, is a mechanism designed to amplify price if and when enterprise adoption finally scales up.
Which brings us back to Chainlink. While Quant is building this future infrastructure, Chainlink already owns the high-velocity network effect in DeFi today. They're securing $20 trillion in value right now. Quant has the institutional moat, but Ellen has the operational velocity.
And that distinction leaves us with one final provocative thought for you to chew on.
We've established that the tokenization of global assets is projected to hit 16 trillion by 2030. So given Quant's confirmed position as this highly compliant operating system bridging legacy finance to that future, the question you have to ask yourself is this: how quickly will institutional necessity, the absolute non-negotiable need for compliant cross-chain settlement, how quickly will that override all this current market volatility and accelerate demand for a token like QNT, which is designed for nothing but pure regulated utility? Because the timing of that institutional flip is everything.